Just a few months ago, pretty much everyone was on the same page. 2024 was going to be the year the Fed finally started cutting interest rates. Well, that whole conversation has completely flipped. Now we're asking if they might have to raise rates again. So today, we are unpacking this huge U-turn and what it means for anyone with an eye on the housing market.
All right, so how did we even get here? Here's our game plan. We'll start with the story everybody was telling just a little while ago, and then we'll get right into the Fed's big plot twist. We're going to explore why they had a change of heart and, the most important part, what it means for your wallet and for the housing market, which is already under a ton of pressure. So stick around and let's figure out what to watch for next.
Okay, let's get into it. To really get why this recent news is such a shock, you have to remember the vibe at the beginning of the year. The consensus, from Wall Street all the way to your kitchen table, was that the Fed was finally going to start cutting rates, and that would bring some much-needed relief to borrowers.
I bet this question hits home for a lot of you, right? So many potential home buyers, real estate agents, you name it. We're feeling this sense of, let's call it, cautious optimism. The shared hope was that we were finally turning a corner on those painfully high mortgage rates and that would maybe, just maybe, unlock a much busier spring and summer in the housing market.
But then, the minutes from the Federal Reserve's meeting on March 17th and 18th were released. And once everyone got a chance to read those detailed notes, it became crystal clear that the conversation behind those closed doors had taken a really significant and, frankly, unexpected turn. Now, on the surface, the headline was no big deal. The Fed held rates steady. Everybody saw that coming. But the real story, the juicy part, wasn't in what they did. It was hidden in the details of what they talked about.
And this right here perfectly captures the plot twist. The whole conversation just did a 180. For months, the only debate was about when the Fed would start cutting rates. Was it going to be June, July? All of a sudden, a totally new and, let's be honest, kind of scary question popped into the room. What if we actually need to hike rates again? Some of the policymakers were even arguing that the Fed's official statement should spell out that possibility. That's a huge shift.
So what on earth happened? What caused this massive U-turn? Why did the Fed suddenly get so nervous about rate cuts and start openly talking about hikes? Well, it turns out a few key things were going on. The bottom line is, some new data came in that just made them nervous. The vast majority of them felt that the risk of inflation getting stuck above their 2% target had actually gone up. A big part of that was a conflict in the Middle East that made oil prices jump, and that always sparks fears about supply chains and higher costs. This got some members so worried that in their own personal forecasts, they kicked the can on any rate cuts all the way out to 2026.
But, and this is really important, it wasn't everybody singing the same tune. There was one person who disagreed, Governor Stephen Moran. He was actually arguing for the total opposite. A rate cut right now. Why? Because he was worried that keeping rates this high was already starting to hurt the job market, which can be an early warning sign of a bigger economic slowdown. Okay, so let's bring this down from the high-level Fed speak and talk about what it actually means for real-world costs. Because this isn't just some academic debate, it directly hits your wallet when you're looking at a mortgage, a car loan, or even just your credit card bill.
And here's the immediate result. Even without the Fed officially hiking rates, just the talk about keeping them higher for longer has sent a chill through the mortgage market. That optimism we were all feeling a few months ago? Yeah, that's pretty much gone.
This number really tells the story. In late March, the average rate on a 30-year fixed mortgage popped up to 6.62%. Now that is a big jump from where it was just 4 weeks earlier in February. The market heard the Fed's new tone loud and clear, and the message is, don't expect relief anytime soon.
This rise in borrowing costs is like pouring gasoline on an already smoldering fire in the housing market. Buyers and sellers were already having a tough time with affordability, and this new layer of uncertainty just makes everything that much harder. So this brings us to a really important idea called affordability compression. It sounds complicated, but it's super simple. Just think about it this way. Say a family could afford a $400,000 home last month. Well, with today's higher mortgage rate, that very same monthly payment might only get them a $370,000 home. That's affordability compression in action. It literally squeezes buyers' purchasing power and shrinks the pool of people who can afford to buy.
And we can see this happening in the actual data. Let's look at this chart. First, borrowing for new home purchases is still pretty low. No surprise there. Second, you see a little tick up in refinancing. That's probably people who bought at the absolute tippy top of rates trying to grab a slightly better deal. But that third bar is the real story. Overall financing conditions are still restrictive. It is still tough out there to get a loan. So, after all that, we're left with the million-dollar question, right? What happens now? Where do things go from here, and what should we all be watching for?
The Fed has been super clear that their plan isn't carved in stone. We had the March meeting, then those revealing minutes dropped in early April, and now all eyes are on the next meeting at the end of April. Every single piece of economic data that comes out between now and then is going to be put under a microscope. The Fed is going to be watching for any sign that inflation is really cooling off, while also making sure the job market isn't falling apart.
And that leaves us right here with this final crucial question. The Fed says their next move is all about the data. Things like their favorite inflation number, the PCE index, and the monthly jobs report. So the future of interest rates, and by extension, the housing market for millions of people, is basically hanging on this cliffhanger. Is the data going to cooperate and show inflation is finally beat? Or are we really in for a much longer, tougher period of high rates than anyone was expecting just a few short months ago?